crypto will demonstrate to billions of people that money is a choice.
What if some of those currencies that we take for granted start to falter or start to be viewed as more high risk? Maybe that level of currency choice that crypto has provided is a really interesting risk mitigator. One of the reasons I'm in crypto, like one of the philosophical values reasons I'm in crypto, is that if you're an early crypto builder, you can really bend that toward optimism.
Ryne, welcome to Unblock'd. It's great to have you on the show.
I'm looking forward to it. Good morning to you.
Good morning to you. You're a physicist by training, a lawyer and a founder and now infrastructure builder. That's quite a diverse landscape of things and not a linear process, I would say, career-wise. What was the actual story that made crypto feel like the right place to solve what you're working on?
That's a great question. I think a lot of my background is sort of maybe a bit accidental, sort of one interest at a time. I don't like to be pinned down by maybe one narrow thing and move on to learning the next thing. And what's interesting about crypto is, okay, so I was like a math and science nerd, and physics is great for that. And during university, I also did a bunch in sort of in the economics department. So it was also kind of like an economics nerd. But that was just kind of like a side interest. And by the time I went to law school, which is a surprise to me, I didn't plan to do that. I discovered crypto kind of during those years, and crypto clicked very quickly. And because it combines a bunch of these previous interests I had that I kind of had to engage separately, right? So the math and sort of cryptography interest is obviously there. The economic implications are enormous. And so is both a technology and kind of just a philosophical movement toward open networks. It was literally the first thing I'd ever discovered in my life that played on all of these pre-existing interests in the same problem space. And so when I got into crypto, not a financial decision, I had no money at the time. It was just purely this kind of intellectual space. They're just oh, wouldn't it be fascinating if this actually becomes a thing? And then 3 or 4 years later, it was just obviously becoming a thing. By that time, I was restless to go build something because kind of my technical background had never left. I knew I wanted to try to build a company. And it was just obvious by that point in time, it needed to be in crypto. It was becoming real. I was not going to be able to keep up with it as a night and weekend hobby. I just needed to go all in. And so that's, kind of the long and the short of how I wandered into this space and why it appealed to me in the first place.
Gotcha. And I mean, at some point you stopped trying to put eco in people's pockets and started to put it underneath the apps that they already use. When did that click, and what did you have to let go of there to actually realize that and make that happen?
Yeah, I mean, that was kind of actually forced upon us. We had to let go of a lot. Some people, maybe some of your audience members will know this, many won't, but I think Eco built kind of the first full-featured stablecoin neobank. I'm aware of some wallets that were adding stablecoin features, but I'm not aware of a designed neobank that runs on, in our case, USDC, being earlier in the market. So we decided to build that product because it was just very apparent by the end of 2019 that the crypto wallets were not mainstreaming. Their UI UX was not designed that way, and it wasn't even close. And so we were actually fairly frustrated with that because we were kind of previously building technology that assumed that the wallets were going to become more mainstream consumer products. That was not happening. And so we said at the end of 2019, well, let's just go do this ourselves. And we built that app, the Eco app. And to know about it, you're probably a US person because this was a US based product. If you do know about it, we built it regulated. We built it custodial because we thought that's the kind of smartest leap for most people to interact with this stuff. And we built a full suite of bank replacement features. We built an early stablecoin backed card, which took us a year of approvals and bank review and card issuance partnership conversations to figure out at the time. We built kind of on-ramping straight in and out of USDC. We built a rewards construct. We built bill pay into that. You could feasibly use it as your primary account and get certain benefits as a result of holding USDC instead of your bank dollar. That was the whole promise and the whole design of the app. The reason I'm telling you all this is when the US bank and regulatory environment turned very hostile toward crypto, a product like ours was a prime target. And so the product did super well. We launched it in beta in 2020, and then we launched it publicly in 2021 and 2022. And it did really well during those first couple of years. And we kind of hit a wall at the end of 2022 because after the FTX fallout, the sort of like crypto was just frozen out in the US, as many people will know. And building that product in a regulated custodial fashion we thought was our moat, and turned into a huge vulnerability. So we had all these kind of banking partnerships that we were dependent on in the background, and we started to lose them one by one as they came under pressure from regulators to debank crypto customers. And so to answer your question more directly, we didn't actually proactively make the decision to go from the app to what we're doing now. It was very much a reaction. The app was kind of choked out of the US banking system, and we ultimately decided to shut it down because 2023 was really difficult, and it was just obvious to us that that product was not going to be free to exist in that era. And so we shut the product down. And what we were left with was an interesting piece of technology that we had built for that product, but we never got to use. The design for that product was to start consumers in this sort of custodial USDC environment, but then to give them opt-in options to get an embedded wallet and to take that USDC on chain if they want to do other things with it. You don't have to, but we're going to introduce those features into the product, right? We're obviously trying to bridge people natively on chain. And so we built that on-chain infrastructure to move stablecoins around really seamlessly for our product. And we never got to use it because our banking partners told us absolutely not. You cannot take this product on chain. And so we're just like, it's a good technical substrate that we never got to merge in. And so after we shut the product down, we looked at that and we said, well, the technology here we think is really good. This problem statement of needing to move stablecoins seamlessly between chains and kind of different liquidity venues on chain, we think is going to become a relevant problem statement. There's going to be a bunch of fragmentation. And why don't we take that technology and turn it into infrastructure for other platforms, other app builders, stablecoin builders to utilize to streamline the UX and to move stablecoins more freely? That's a bet we made about 6 months after we shut the app down, and that's been the direction of the company ever since. So it's a bit of a long answer to your question, but it's kind of an interesting storytelling answer. We kind of ended up in this position unintentionally, but a lot of our best technology is sort of like fed into what we're building now.
Nice one. Yeah. So, I mean, Eco started as a consumer savings app, and now it's infrastructure for stablecoins liquidity.
Correct. Way back, we actually started also as infrastructure for stablecoin liquidity, but no one needs to know or care about those first couple of years because it's just like way too soon, right? That was 2018. We thought Ethereum was going to scale faster. We thought stablecoins were going to scale faster as a use case. We thought the wallets, like I said, were going to go mainstream. None of that happened. So the first kind of like year and a half of the company is almost just like, you can think of it as like an R&D period where a lot of our assumptions about how quickly this sort of technology would be adopted were incorrect. And it's just interesting to point out because we're kind of full circle. We started out building infrastructure for stablecoin adoption. We've built the app because that wasn't happening fast enough at the infra layer. And we went back to infra.
Yeah, it is full circle. It is worth mentioning. So you're building the routing layer that makes stablecoins actually move. But by definition, concentrating liquidity, routing through Eco makes Eco like a new intermediary of some kind. And if Eco succeeds at scale, have you solved like the concentration problem, or have you just moved it one layer up?
So there's a really important distinction that I would make. We aggregate liquidity, but we don't own it all. So you can think of Eco's architecture as kind of like two layers. There's like this base layer that does the liquidity aggregation and the routing logic. And that's just like the substrate that's really, really good at moving money on chain. Whether you're trying to move between major stablecoin assets or major DeFi markets or major chains or some blend of those things, that layer is really good. And that's protocol and smart contract based, and anybody can call to it. And it incentivizes liquidity aggregation and reads sort of into market liquidity from a number of different sources. And so that's a really important distinction because we're not like in-housing or concentrating liquidity in a way that we necessarily broker. So, and we need to incentivize kind of liquidity actors to permit their liquidity to be utilized by that layer. but ultimately anyone can move money across that layer, and they don't need to actually go through eco. The second layer of our architecture is a layer of permissioned APIs and tools, et cetera, that you may want to use for more specialized purposes, right? Like the first layer that anyone can use, they can just tell it, I want to move money between point A and point B, and they'll get a quote for moving it, and they can take it or leave it. The second layer, the sort of like tooling layer, allows them to like embed more logic. Say, I want to move money for reasons A, B, and C, or with conditions X, Y, and Z. And that's where we look a little bit more like a traditional SaaS layer, right? We are a company building those tools to help streamline money movement for use cases that we decide to focus on that we think are valuable. So that's a really important distinction. If we succeed, kind of the liquidity aggregation is always there for the network to take advantage of. And we hope that we can sort of build network effects around that at the base layer. And then we'll probably continue to build, APIs or services on top of it that we think just like help certain types of parties move money better. And so that would be the important distinction that I would make there. If we succeed like we want to succeed, eco only becomes an intermediary, quote unquote, insofar as you want to use kind of like a specialized service, but not at the core like permission layer of can I move money with eco or not. Does that make sense?
Mm-hmm. Yeah,
Yeah.
and thanks for drawing that distinction. I mean, I think that stablecoins hit like a turning point when TradFi stopped ignoring them. And I mean, you've been building, as you said, since 2018. What did you see 7 years ago that everyone else is only catching up on now?
There were a number of people that realized this at the time. Some of them survived and some of them didn't. It's pretty simple. It's just like, this is inevitable payment technology. It's just better. And I don't know how long, in 2018, we're like, I don't know how long it's going to take the world to realize this, but it's literally just fundamentally better. I think we realized that because everybody that kind of had anything to do with starting eco, some of our early advisors, my co-founders, we all understood the traditional world of payments fairly well because we had kind of had some e-commerce experience. And so we had wrestled with card processing, and we knew kind of a bit about that stack. And we knew how inefficient it could be for digital payments in particular. And clearly it's become well optimized over time. Stripe's done a ton of work to make that accessible, but it's still sort of like there's a number of layers within that we thought aren't very efficient. And stablecoins are just going to disintermediate a lot of that process and just money that moves better. And that's just like a fundamental truth to the technology. And so that's all we really saw. And it's like it's just a matter of time before money, like back to physics, right? Like money flows like fluid dynamics, right? Like if you give it the opportunity, it will choose the path of least resistance, lowest cost, fastest clearance. And of course, it's restricted from doing so by regulations and by sort of like bank payment networks today. But if you introduce an entirely new paradigm where it can flow more freely, the incentive is going to be there to route it that way.
Mm-hmm.
And so it wasn't like some like huge unrealizable insight. It was just like, it was kind of like hiding in plain sight, right? It's like, oh, this is just like obviously better. And it took way longer than we realized for regulatory clarity to come around and reinforce that. And then for the institutions to then leverage that regulatory clarity to start adopting it themselves. But the technical fundamentals were always there from the beginning. And so that's what we saw. And it didn't actually seem like that outlandish of a bet when we started building. It seemed like crypto was starting to grow up a little bit. We'd had Ethereum for 3 years. We'd had Bitcoin for 8 years or something like that. And it seemed like, the bet of this technology continuing to be adopted, continuing to improve and scale, and the stablecoin use case being built on top of it seemed early, but it also seemed clear.
And with that kind of analogy of, it being like water and moving through to the, the most efficient kind of pathway for like smaller economies, you've acknowledged that if stablecoins scale quickly, it could effectively half currency flows in dollars, not local currency. How big a risk do you see that as being a destabilizing factor in those places?
So that's one of the most interesting kind of like macro questions to me. I don't actually think it's a huge risk for two reasons. I think it's a super interesting thought experiment, but I don't think it's a huge risk for two reasons. One reason is that some economies want to pseudo dollarize. They might not formally dollarize, but they might sort of like calibrate or peg to the dollar. And that might just accelerate their ability to do so. So then, like, in that case, the incentives are aligned. In the cases where incentives aren't aligned, countries will if they see that starting to happen, countries will quickly react like they always have, and they'll impose capital controls. Like that, they'll just regulate kind of how you can get in and out of this technology, how you can get in and out of dollarized stablecoins or local currency stablecoins, and they'll do so relatively quickly. And that's fine. That's just like what always happens. And
Mm-hmm.
so I think practically it's not that big of a risk. Although I do think like one of the most fascinating things about the technology it gives you free access to alternative currencies. And most often in stablecoin game today, that's the US dollar. And so it is super interesting to see like how quickly does that draw nascent demand into dollar access. I think it's very likely that that compounds and happens more quickly than people realize. I think that's actually already happening. And so that's a very interesting signal. But at the end of the day, if that actually kind of becomes statistically significant to some emerging economies that don't want to align themselves with the dollar, they'll just do what they've always done and kind of limit product accessibility to get in and out of that currency or in and out of USD stablecoins. And that's unfortunate, maybe, but it's also like fine. It's just like the way the world works.
Mm-hmm.
Yeah.
I mean, I would say the dollar standard is being reinforced by stable coins, the existence of them, with things like oil, where certain countries are now asking oil tankers, to pay in yuan to pass through the Strait of Hormuz. Would you say that stable coins are strengthening the dollar or opening the door for the yuan? Do you see the petrol dollar loop breaking in any way related to stable coins?
I don't think so. I think stablecoins bear on that very much. I think that larger, higher up geopolitical decisions bear on that mostly.
Mm-hmm.
Like there's a digital yuan, there's state USD stablecoins. Maybe those technologies make it such that those currencies maybe are a little easier access, certainly way easier to move in certain circumstances. But I don't think that the currency competition is really at the stablecoin layer right now,
Mm-hmm.
higher up the food chain.
Many are talking about like the drift hack and contemplating why it happened. In that context, Circle, I think they had 6 hours and like the technical capability to freeze was like more than $200 million stolen in USDC that moved through their own bridge, but they didn't act. And I mean, as a founder building on a stablecoin infrastructure, does that change how you think about counterparty risk with issuers?
Okay, so we think about counterparty issuance a lot, or counterparty risk with issuance a lot, but it's kind of separately from the question you actually asked. And so I can speak to that.
Mhm.
On the specific circumstance of drift and circle, I'm as interested to see what happened as anybody else. So I don't know. Circle hasn't really said anything. It seems like one of their core product promises was not delivered in that moment, and that they really need to acknowledge that at least. At the same time, DeFi needs to like decide what it wants. Everybody wants decentralization until something like that happens, and then everybody's asking, why didn't you hit the kill switch?
Totally.
And like, so that's an obvious double standard. And either one is fine. But if I was building a DeFi protocol and I was going to sort of like build a major market on a particular stable, you need to make that choice intentionally. Like you need to, as a protocol, you probably need to say, we're going to sort of default our markets to USDC for this feature, or we're not, because our value system does not we do not want to admit that feature into our philosophical framework. And either one is okay, but you probably need to say it and then let your market participants price it. That's my opinion there. And so it's just interesting every single time this happens, right? Like the, you know, the DeFi people who are at least surface level decentralization maxis want to hammer why weren't the funds frozen? And we can freeze funds for pretty good reasons sometimes, right? But also Circle needs to like they need to say something
Mhm.
here. And right, like it's a pretty big lapse if hundreds of millions of dollars are flowing toward known kind of sanctioned directions and addresses, and you see those flows happening for many hours, and you're a multi-billion dollar company with presumably hundreds of people and analytics tools designed to monitor those flows, and you miss it and then you don't say anything. So clearly there's liability risk in that, but they need to fix that. but I don't know anything more than that, more than anybody else does. What's interesting for us on stablecoin counterparty risk, there's a couple ways that factors into how we think about our own network. One is counterparty risk is really collateral management. So like different stablecoins have different collateral models. And nowadays, most stablecoins that everybody uses are centralized collateral managers. And so the price of the stablecoin or the price difference between two stablecoins is largely a reflection of not only the difference in liquidity in the open market, but also their different collateral models. They're not exactly the same thing. And so we think about it from a pricing perspective. If you want to be able to price stablecoins really well, part of that is like a risk margin on is someone's collateral backing a little bit more risky than somebody else's. That's the first way we think about it. The second way we think about it is some compliance sensitive parties that want to transact over our network, like, are going to whitelist what liquidity and what stablecoins they're willing to interact with. And that is a counterparty risk that they're basically communicating to our network to control for. So that's the second way we think about it. It's just like some transactors across our network have different sets of requirements and conditions with respect to what stablecoins they're willing to hold or pass through.
Yeah. So, I mean, the problem is like execution certainty. And I think what you're saying is you think you're using something that's decentralized and permissionless, but it's actually not that. And you find out afterwards. But if you understand philosophically what the actual approach is and what the attack surfaces are, and sometimes it might be smart contracts or keys, etc., then people can price that in and understand the return that they expect, taking account of the risk. But it's where that they think it's a certain way, but it's actually not, and they find out afterwards that's a big part of the problem.
Well, I mean, people should price that in,
Yeah,
right? Yeah. And the space is growing up accordingly. And hopefully that happens in better and more transparent ways going forward. Certainly, if we mess up enough times, it's going to be forced to happen in certain ways by regulatory boxes that are going to be drawn around the DeFi market. That's probably inevitable.
definitely. I mean, the stablecoin settled about $32 trillion last year, and there's a gap between the price you're quoted and the price you actually get. How is that not just a crypto version of a problem fintech solved 20 years ago?
Well, it is. We just need to solve it in a new way because the money moves way faster and the markets are way more dynamic. And so the infrastructure that we built to solve it 20 years ago is just insufficient at the scale and the velocity of money that I think that we're going to end up with in these markets. And there's a few structural differences, which are like the large TradFi markets are largely isolated from each other in terms of liquidity can't like flow instantaneously between them. It needs to be cleared. There's some delay in that. And that's why a number of intermediaries exist. Whereas in crypto, you have chains and DeFi markets that are kind of like intra-block composable. And so liquidity can flow much more dynamically, can price across those markets. The theoretical velocity of money and volume of those flows that we may realize in the crypto ecosystem, the on-chain ecosystem, gets way higher and way more dynamic. And so those pricing problems are like higher frequency. And so even a simple send or swap, pricing it across the crypto ecosystem, we could assume that like demands high frequency trading type of infrastructure within like a year as chains get faster and as velocity of money gets faster. And then as agentic transactors, whatever that ultimately looks like, inevitably come online. So in some ways, the analogy like holds really well. It's kind of like we're reinventing stuff that we've already had to solve, but with new structural opportunities and with new structural constraints and more open markets. And so I just don't think that TradFi infrastructure, confined as it is to existing market structures and regulatory dynamics, is like well positioned to evolve in this direction. We need to take a lot of the best ideas for kind of market performance in TradFi. We need to take influence of them or from them, but we still probably need to re-engineer how we do a lot of this in the on-chain ecosystem. And like for us, obviously that's part of our opportunity.
Mm. I mean, if you look at like USDG, the market cap on that has like flexed within like less than a year, and you're now routing that through Eco. What does that tell you about where demand is actually originating from? And is it the beginning of real issuer competition or just another dollar with a different logo?
Both. I mean, the issuer competition is hot right now. There's 5 or 6 major issuers that I have in mind just off the top of my head, and the competition is hot. Now, a lot of them offer pretty similar kind of genius compliant collateral backing. And so the stablecoins are like kind of the same. They're certainly within their ecosystem pretty much the same. And so those are just like different logos that call to the same collateral network in the background. So that's why I say it's kind of both. In our network, we are not trying to be like an every chain, every stable proposition. So I kind of think of like we want to sit in what I think of as the stablecoin wholesale market, which is there's a shorter list of chains, a shorter list of DeFi markets, and a shorter list of include vaults in DeFi markets now, and a shorter list of stablecoin assets that are going to do the lion's share of settlement volume. And even some of the longer tail stuff will tend to round trip to the liquidity of the wholesale market. And so that's what we optimize for. And so we only choose to support a chain or a market or an asset when it's showing like real demand. And as you mentioned, we added USDT support just in the last quarter because of that growth. And the demand driver is actually pretty simple. Genius Act finally passed in the US, and institutions are realizing that there is margin to gain by controlling their own stablecoin if they have a product ecosystem where it makes sense to have a stablecoin. Maybe even margin to gain just by adopting somebody else's stablecoin. You get a little bit of transaction margin on the way money moves. And they just needed the regulatory clearance to kind of jump in. And so that's the simple demand driver. It's regulatory clarity and an incentive structure that's long made sense to institutions. They were just waiting on the clarity they need.
Yeah. So, like, for example, credit card issuers where, card points and cashback are really big, particularly in like the US market. But I mean, that's not really a factor in other parts of the world. Would that be like a differentiating recipe for stable coins to, I mean, yield generation is another one of the aspects that makes them significantly more attractive than fiat. How do you see the landscape evolving around this?
Yeah, I have a very US centric point of view, as you mentioned, right? We have fintech apps that have kind of like captive audiences and user bases. Makes a ton of sense if you're in that privileged position. We were at like a tiny scale with the Eco app, but obviously you have your Robinhoods and your Revoluts, et cetera, that are at massive scale. If you're in that very privileged position, I think it makes tons of sense to launch a stablecoin because for many reasons. One is, well, we're all waiting to see what happens with the Clarity Act. How can you pay yield out? Can you even pay yield out? But presumably in some shape or form, you're going to sort of find ways to uniquely incentivize users depending on what the Clarity Act ultimately enables, whether it's yield pass through or some rebate reward structure. They'll figure it out. They just need to be told what are our limits, and they'll go figure out a good framework. So user loyalty is a lever that you're going to be able to pull uniquely. You're going to recapture some unit economics on yield margin on the back end, probably, and you can recycle that through your product in other sort of incentivized ways. So you gain some profit margin to play with, either to retain or to further reinforce user loyalty and brand loyalty. And so I think it makes a ton of sense to launch a stablecoin, and I think they literally all will. And if they're good at product UX, they will just still call it a dollar or a reward point and not throw another acronym at the market, right? I hope we don't have to keep track of all of that. But behind the scenes, it'll be their own stablecoin and they can leverage it for unique reasons. And so I think that that's the curve that we're going to see, and it's already underway. And I think that's where a lot of the opportunity is for these businesses sort of in the fintech sphere here. Now, if you're abroad and not in the US, it's a huge opportunity to be the solution to give a bunch of people access to the dollar first. That's a great reason to launch your own stablecoin too. Like you can kind of like double dip on user loyalty in that way. Your product is giving people that access, and your asset is their first kind of like default dollar. That's a really good reason to also, I think, launch a stablecoin. Now, in some jurisdictions, they're already used to existing stablecoins, so there probably is that network effect, and you just want to like leverage that and not force them to switch. In other jurisdictions, it's a wide open opportunity to introduce people to a digital dollar for the first time, and maybe it's a little more fruitful. That's an interesting opportunity to watch as well, with a lot more geographic fragmentation.
And I mean, Solana stablecoin supply cost, I think, 17 billion. And in February, there were 650 billion in stablecoin transactions. And that's the highest monthly volume ever recorded on any blockchain. I think Eco integrated with Solana in December last year.
Yeah.
What are you seeing on that chain specifically that you're not seeing anywhere else?
Well, clearly there are the performance advantages to Solana. That sort of its entire product promise. So like faster payment clearance, faster trading optimization has always been Solana's thing. Other chains are coming into that space, but that's like Solana's like solely focused on that since day one. But I think it's just focus. It's just like focus. And we are going to win institutional stablecoin volume by giving the best suite of tools for highly optimized payment and trading flows with stablecoins. Now they're like fairly early in that, but they're investing in it heavily. They're literally building teams to deliver on that promise, and they're expanding the Solana developer platform to deliver on that promise, and they're doing high level business development. The only other general purpose chain that I see similarly pulling that off and focusing is Polygon right now. Those are the two in the market. And then of course you have Arc and Tempo, et cetera, coming online with more of that focus from day one, but we kind of think about them differently because they're kind of earlier stage and corporate sponsored. But in the market of general purpose blockchains, doing a great job of focusing on a use case and kind of making like real headway in business development. It's Solana leading the way, and it's Polygon catching up as well. And so that's what I see from them. It's just like pretty simple. They decided it's a strategic priority, and in both business development and in developer experience, they've started to invest in ways that are market leading, and we intend to grow our support of that ecosystem materially, not just support it, but like really help them penetrate with our best tooling and options for money movement. And I would say that that's a really interesting area of opportunity and a space to watch for eco this year.
Gotcha. I mean, you raised like $90 million from A16Z, the Founders Fund, and Pantera. What was the one thing apart from the check that they contributed to the success of eco that's oftentimes perhaps getting lost?
I mean, it's obviously different for each one, but the thing I'll say of all of them is patience, right? Like they invested in the app era, and our app was ripping. It was telling an amazing story. And then we had to shut that product down, and we decided to reinvest and rebuild at the infra layer. And it was mission consistent with what they invested in, but it ended up being a very different product. And I've had full license to take that swing. And so when you have really mission aligned investors who are also just really good investors at the venture game and understand that you kind of got to navigate to find your way, sometimes having that license and that support and that patience when the market kind of turns in an unexpected direction is the thing that I can say is a common denominator where we've been very fortunate.
Mm.
Now, clearly we have a massive sense of urgency, but I have felt nothing but support from my major investors in the 2 years since we charted this new direction, and belief from them that we're gonna figure that out. And I would add Activent to that list as well. And so, and then they all offer like something like a little bit different. Like A16Z is so crypto native, and they are just like so long. Like crypto investors, a lot of times, generally, they get this kind of rap for being short termist. Like, no one we're talking about here is short termist, and like A16Z is just like they're thinking in decades. So that's one thing about them. Pantera is just like a first mover market expert with some of the best portfolio network effects and some of the best like liquid fund and liquid market intelligence. Founders Fund speaks for itself on the network effect of their founder quality and just like their ability to see things before anybody else in the market does. The brand there is just incredible in that way. And then, Activent on their kind of like core fintech expertise. That's the only thing that they really invest in, mid growth stage mostly. And they just have like really deep level of sophistication in supporting fintech, payment related money movement companies in terms of their unit economics, their pricing models, their go to market penetration. And they're a real success story in that regard. That's what I'd say specifically about each one.
Mm. I mean, with your focus on infrastructure rather than consumers, it sounds like the next wave of stablecoin users for you won't be individuals. They'll be PSPs, fintechs, issuers, treasury teams. And those buyers don't adopt infrastructure through white papers. They do that through procurement cycles and compliance reviews and SLAs. What does your sales motion look like for that customer, and how long does it take?
Yeah, we're just figuring that out right now, to be honest. So the way we've gotten to market for the last year is we've mostly worked with platform partners that are themselves like developer platforms.
Mm-hmm.
And so the first order challenge for us is to optimize dollar flows between the major on-chain markets. And so for the last year, year and a half, we mostly worked directly with stablecoin issuers, blockchains, some DeFi platforms to optimize liquidity and routing among them. And
Hmm.
so that for us is, it's still a little bit longer sales cycle, but it's a familiar conversation because they're crypto builders, right? Just now have we, like in the last, I would say 3-4 months, do we feel like we've networked the dollars, the on-chain dollars well enough to kind of start to go up market a little bit? And so now we co-sell and co-develop with many of them to their target customers. That's a motion that we have. Because our technology has given them a unique capability to offer to an institution that they've been recruiting. And then separate from that, we're just now kind of like figuring out our own motion to go more into the institutional enterprise market directly. And I think that's our opportunity for this year. And much of the way our own like financial roadmap and product roadmap and are designed assumes that we need to build that capability. And so, we'll see. I'm in the very early stages of that. I still sort of like the tip of the spear on a lot of those conversations, and we're starting to build a sales organization internally to kind of take the patterns we've seen that we think are repeatable, the product opportunities that we know are compelling to those types of customers, and take what is maybe a 6-month conversation now and see if we can accelerate that in various ways. I think you'll see eco kind of like go up market in that way, which would be really interesting, kind of like positioning evolution for us, right? Like we are on-chain builders. Our partners are like other on-chain builders that have significant clout, certain chains, certain interop networks, etc. And we're all figuring out how to have that conversation. I think a really good example to look at right now is Morpho,
Hmm.
right? Deep DeFi builders. Now they're talking to institutions and banks all day. So they have figured out that motion and invested in it over the last 6 months. And maybe we're a couple months behind them in a similar curve, but you'll see that pattern from, I think, a lot of leading crypto projects that have some level of scale. And I think actually our regulated background is going to give us a real advantage in those conversations because we've lived it. We were a money transmitter with our app. We've had licenses in the past. We know what those requirements are going to be, what compliance sensitivity a lot of those procurement teams and a lot of those institutions are going to need to see satisfied. And that's just a language we speak very well, and I think kind of natively better than most on-chain teams, obviously. And so we're building that motion.
Makes sense. You just launched a new product called Programmable Addresses, which tackles the receiving of money movement on chain. Can you talk us through a use case of what that does and what was broken that needed this product?
Yeah, so and it's actually an early version of a broader product that I can kind of speak to as well. But programmable addresses is simply you can give your users a product specific address. It can even be like a subdomain for your product, Ryne.eco.eth, something like that, and attach routing logic to it. So, we have this general address paradigm across the on-chain ecosystem, but you have different addresses for different reasons. Even personally, I have like a MetaMask for my petty cash, and then maybe a multi-sig for like, other funds management reasons. And there's different products that have on-chain addresses for different reasons. And so one very simple thing is if I'm a fintech product, I want to give my users an address and I want to let them send stable coins or maybe ETH or SOL from any direction. And I want it to settle as the target stablecoin in my product. And I don't want to force my users to make sense of some multi-step journey. I just want them to be able to send money from anywhere or request money from anywhere and then have it settle in my product in the right place in the right asset. That's a very simple use case that still is not sort of standard fare in the market. And so that's probably where the earliest kind of users, that's definitely where the earliest users are. They're fintech app builders. They want their app users to default to a stablecoin on a chain, but they don't want to restrict their users to paying or accepting only that stablecoin on that chain. They just want it to settle automatically. And there's more complex things you can do. You could give a treasury address that settles with more advanced logic, more advanced routing logic, either coming in or going out. A payment settlement address that settles in some split across maybe different assets on different chains
Interesting.
because you need to manage liquidity accordingly. So you can do more and more advanced things with programmable addresses. Programmable addresses are an early kind of MVP of something that we call programmable transactions, which have much more advanced routing logic for how you execute an on-chain transaction and control for price risk or other types of risk management as well.
Gotcha. You've said that there's far more institutional traction in stablecoin infrastructure than anyone knows about? Is it because it's boring or people don't want to talk about it? Like what's holding them back from actually saying it in the public
Nothing.
domain?
People want to talk about it. It's very simple. One is major enterprises always want to pilot privately before they want to announce it publicly. Most of the time, some want to make the splash, but I think 9 out of 10 want to get really comfortable with the technology before they really like announce that they're doing it. And then when they announce it, they want to say that like it has some social proof. And so I think right now what we see in the market, and we're involved in a couple of these ourselves, is private pilots that are going to last 1 to 2 quarters before and they're gonna convert, but ultimately the institution needs to get comfortable with these flows, needs to benchmark them, needs to optimize them, and then they'll say whether they're doing something with it over the summer. So that's just a practical thing. The other thing is a lot's like gummed up by the Clarity Act debate in the US. And so there probably would have been more announcement around stablecoin adoption at the institutional scale in Q1 had the Clarity Act not like hit a bunch of snags and thrown doubt on some of the stablecoin kind of regime and requirements that they're going to have to adhere to. And so I think you saw maybe the announcement timeline or the adoption timeline for a bunch of enterprises pushed back by 3 to 6 months. And hopefully we get resolution on that relatively soon. It's long overdue.
Yeah, I mean, there's an argument that the Clarity Act's yield ban doesn't push users towards DeFi. It actually pushes them back to banks and money market funds. Eco is not like a yield product. Your infrastructure for that ecosystem, though, if DeFi loses the yield war to regulated finance, who actually gets hurt the most?
You know, an interesting thing right now is like DeFi is losing the yield war. Most like risk-free yield on chain right now is like 2%. So you would be rational to move it in your like high yield savings account in your bank and get twice that. Uh, But that's like simplistic to say because there are network effects with liquidity on chain and off chain, and there's friction in moving it both places. And so even if I'm giving up a point of yield on chain, I might want to keep my money there because the other opportunities I want to take advantage of are just a step away. And so it's kind of like there's some complexity in that answer. Ecosystem in a really interesting position is relatively neutral. It's just like show us demand for flow, and the network will optimize to serve that demand. You know, among the major chains and assets that we support. And so as a stablecoin believer and a DeFi believer, I'm obviously highly interested in the answer to your question. As a leader of our company and as a product builder, I'm maybe a little bit more agnostic than most people would guess
Mm-hmm.
because it's just like, okay, well, it's going to come out one way or another. Flows are going to adapt to that. Eco will adapt to those flows. Does that make sense?
Yes, it does.
Yeah.
We're starting to see products offering like fixed yields on stablecoins, which feels closer to like savings accounts than anything crypto native. But if that yield is ultimately subsidized or engineered and not purely market driven, what happens when the incentives disappear? Do they still win users on their own, or is the yield the only real onboarding lever for retail?
Yeah, I think it's a real risk. So you have got to build network effects or other incentives in besides that. This is a really interesting distinction. So this happens all the time at banks. Sign up, get an incentive, like a cash payment for staying there 3 to 6 months or a better interest rate, and that's temporary. And then it goes away, right? But once your bank has you, they have you because there is so much friction psychologically and logistically for moving your money out of that account after you build your financial life around that primary account. That is an advantage that banks have. Currently, DeFi does not have that advantage at all. If you can get into the DeFi product, you can probably figure out how to get out of it, and you can get out of it quickly. And so unless they build a very captive kind of like app layer product experience, or they're embedded in a fintech product that builds other incentives around holding your money there, rewards, liquidity, network effects, etc., there's that risk. And that's a really interesting distinction that may be underappreciated, I think, in the market, but it's still early there. And as soon as we get clarity and those fintech products start to adopt stablecoins, like I've said, they will build those incentive structures around more DeFi defaults. But the DeFi protocols themselves do not have defensibility there. They need to partner with app layer product builders and other liquidity managers and adopters to start to build some network effects that make the flight risk a little bit, that mitigate the flight risk.
Mm-hmm.
Yeah.
I mean, you've said that, I think on a CNN interview, that crypto will demonstrate to billions of people that money is a choice. What do you mean by that?
Well, you're going to have, I mean, you're going to have currency choice. Many people are going to have currency choice for the first time. What currency do I use? Not just what product do I use? Like we have that choice in many geographies today, like different ways to use my dollar. But in other ways, you're going to have choices between different digital dollars. You're going to have choices between different yield markets more than ever before. You're going to have choices between different currencies entirely. You know, there's other non-USD stablecoins that are inevitably going to come online as well. People never had that level of choice. So I'm sure like regulations will serve to restrict that a little bit, but it's a really, really interesting opportunity for crypto. It always has been. And I'm here for that. In the longer run, I've said this before as well. Risk is seeming a little bit far out there, but what if countries are not very good currency managers a lot? What if some of those currencies that we take for granted start to falter or start to be viewed as more high risk? Maybe that level of currency choice that crypto has provided is a really interesting risk mitigator. I don't know. We'll see.
I mean, we talk about choice like, it's in and of itself a better thing, but is there a version of that story where that level of choice actually worries you?
Yeah, there is. I mean, if you take that to like its theoretical max, right? What if some of the reserve currencies we have in the world today start to be viewed as overly risky? In that circumstance, crypto, I've said this many times, but crypto is going to expose the reality to a bunch of people that money is like a collective choice, and clearly a lot of us are forced into the currency we chose at a young age because we live in a particular place. But if you have access to different currencies, you realize that a lot of the stability function to a given currency is people's choice to trust in it, and maybe a lack of an alternative to route their financial life elsewhere. And if you have enough people that realize that, if there was like a destabilizing moment where a bunch of people realize that at kind of relatively the same time, then it's either incredibly destabilizing in the world, or it's an equitable opportunity for people to find stability with options they've never had before. And one of the reasons I'm in crypto, like one of the philosophical like values reasons I'm in crypto, is that if you're an early crypto builder, you can really like bend that toward optimism. You have like an opportunity to build in a way that bends that outcome toward optimism, and not like a fracturing force, but give people kind of the right on ramps and the right off ramps for their financial life, the right level of choice for their financial life that makes that an equitable opportunity. And I think that's a really important reason for being here.
Wonderful. Ryan, it's been a pleasure to chat with you. Thank you so much for your time and congratulations on what you've created so far with Eco. Look forward to following your progress and success.
Yeah, thank you so much. It's still early, but we're trending well. It's really good to speak with you. The questions were great. Really appreciate it.
Pleasure.